If the United States crosses $40 trillion in debt, something will break, and it will not be obvious at first. There will be no sirens, no emergency broadcast, no overnight crash. The real danger is not the number itself. It is what historically breaks when a nation reaches this stage of the debt cycle, and history is very clear about what tends to happen next. Right now, most people see rising debt as just another headline, another political argument, another number that feels too big to understand. But debt at this level changes how money works. It changes how governments behave. It changes how markets react, and eventually, it changes how your savings hold value. Before we go deeper, if you care about understanding money, power, and the forces shaping the next decade, make sure you like this video and subscribe to Think Like Dalio. This channel is about seeing the system clearly before it shifts, and what we are about to discuss is one of the most important shifts of our time. The United States is moving toward a level of debt that historically marks the late stage of a long-term cycle. Debt itself is not evil. In fact, debt builds nations, it funds wars, it builds infrastructure, it expands opportunity. But when debt grows faster than income for too long, the math quietly turns against the system. At first, nothing looks broken. Growth continues, markets rise, confidence holds, but underneath, interest payments begin to consume more and more government revenue. Instead of investing in the future, the government starts paying for the past. That shift is subtle, but it changes everything. Think about it this way. Imagine a household that earns $100,000 per year. If their debt payments are small, they can invest, save, build. But if their interest payments grow so large that they consume 30 or 40% of income, flexibility disappears. Now they are managing debt instead of building wealth. Nations are not so different. When debt approaches extreme levels, governments are left with only three real choices. They can cut spending, they can raise taxes, or they can print money. Every major empire in the last 500 years eventually faced this exact decision. Cutting spending sounds simple, but it is politically painful. Social programs, defense budgets, infrastructure projects, these are deeply embedded in society. Reducing them creates unrest. Raising taxes is equally difficult, especially when political divisions are already high. That leaves the third option, expanding the money supply. Printing money does not look dramatic at first. It often feels supportive. Central banks buy government bonds. Interest rates stay lower than they otherwise would. Markets feel protected, but increasing the supply of money reduces the purchasing power of each unit over time. It is a quiet transfer of value. This is where something begins to break, not the stock market immediately, not the banking system overnight. What breaks first is confidence in the stability of purchasing power. When investors begin to suspect that debt will be managed through currency expansion, they demand higher returns to compensate for inflation risk. Bond yields rise. Borrowing becomes more expensive, and the debt problem feeds itself. The United States has benefited for decades from a unique advantage. The dollar is the world's primary reserve currency. Countries hold dollars. Trade is settled in dollars. Global debt is often denominated in dollars. That demand creates structural support. But reserve currency status is not permanent. It is based on trust. Trust in fiscal discipline. Trust in political stability. Trust in military strength. Trust that debt will be honored without destroying the value of the currency itself. When debt climbs toward $40 trillion, the world begins to ask a quiet question. Can this be managed without debasing the currency? That question alone can shift capital flows. Historically, what breaks first in late-stage debt cycles is not the currency overnight. It is the bond market's willingness to finance deficits at low cost. When investors demand higher interest rates, government interest expenses surge. That forces more borrowing, which requires more issuance, which pressures rates further. The spiral begins slowly. At that point, central banks face a dilemma. Do they allow rates to rise and risk recession? Or do they intervene and buy more debt to keep rates contained? If they intervene aggressively, they expand the money supply further. If they do not, the cost of servicing debt can overwhelm fiscal capacity. This is not theory. This pattern has repeated across history, in different forms, in different nations. The names change, but the mechanics remain strikingly similar. Now here is where it becomes personal. When governments lean heavily on monetary expansion, asset prices often rise. Stocks, real estate, commodities. It can feel like prosperity. But if asset inflation outpaces wage growth, inequality widens, social tension increases, political polarization deepens. Late-stage debt cycles are rarely just economic events. They are social events, political events. They strain institutions. You may ask, why 40 trillion? Is there something magical about that number? Not exactly. The absolute number matters less than the relationship between debt, income, and interest costs. But large round numbers carry psychological weight. They attract attention. They force conversations. When interest payments become one of the largest items in the federal budget, flexibility disappears. And flexibility is what keeps systems stable. Another thing that tends to break first is policy unity. When debt is manageable, compromise is easier. When resources tighten, politics becomes more aggressive. Competing groups fight harder for limited fiscal space. That internal division weakens external strength. Global investors watch these dynamics closely. If they perceive rising instability, they diversify. They reduce exposure. That diversification does not happen overnight. It happens gradually. But over time, it compounds. Imagine a world where a slightly smaller percentage of global trade is settled in dollars each year. A slightly smaller percentage of reserves is held in dollar assets. That marginal shift can influence demand for U.S. debt. And in a highly leveraged system, marginal shifts matter. Another subtle break occurs in expectations. When citizens begin to assume that inflation will remain elevated, behavior changes. People spend faster. They borrow differently. They invest differently. Inflation psychology can become self-reinforcing. Confidence is the foundation of any monetary system. Once confidence erodes, restoring it becomes expensive and painful. Now this does not mean collapse is guaranteed. History does not repeat in identical form. The United States still possesses enormous strengths, innovation capacity, deep capital markets, military power, entrepreneurial culture. These factors matter, but strength does not eliminate cycles. It influences how they unfold. One possible path forward is controlled adjustment, moderate inflation, gradual fiscal reform, stable growth. That is the optimistic scenario. Another path is prolonged stagnation with periodic financial stress. A more severe path involves sudden loss of confidence leading to rapid currency adjustment. The key point is that high debt narrows the range of painless outcomes. For investors, the most important question is not whether the number hits 40 trillion. It is how policymakers respond when interest costs accelerate. Do they choose structural reform or monetary expansion? In many past cases, expansion was politically easier. Let's pause for a moment and think deeper. Debt is simply a claim on future income. When debt rises faster than productivity, future claims multiply without equivalent output. Eventually, those claims must be restructured, inflated away, or honored through growth. growth is the cleanest solution. But sustained high growth becomes harder in aging societies with slowing productivity trends. That is a structural challenge many developed nations face. If growth cannot keep pace, then adjustment occurs through other channels. That adjustment phase is where volatility increases. Here is another element that often breaks quietly: market correlations. In stable periods, bonds can offset stock volatility. But when inflation risk rises, bonds and stocks can fall together. That removes a traditional portfolio stabilizer. Investors must rethink risk management. At Think Like Dalio, we focus on understanding systems rather than reacting emotionally to headlines. Systems move in cycles. Debt cycles are among the most powerful. A long-term debt cycle can last decades. It builds